devaluation of China's currency has sent shockwaves across the world and continues to feature heavily in headlines. Volatility in equity markets have soared to levels not seen since the aftermath of the 2008 financial crisis. I'm here today at Columbia Threadneedle Investments to drill down into what the real impact is and how it affects investors like you. Toby Nangle's here with us today to discuss some of the key issues that have come up during their monthly investment themes meeting. Hi Toby. Markets are down over the last month, but what has really changed on the ground?
I mean, you're right, markets are down, 10% over the month on equity terms? That's a huge fall. And what really has changed, there are still three big themes that are facing investors. First of all, you have the US economy actually doing pretty well. Everything's actually going great. The dollar's stronger as a consequence of this because the Fed is going to be hiking rates. That's causing a little bit of concern in emerging markets. Secondly, you've got this big oil supply shock that's been hitting commodity markets. A lot more oil supply from shale producers and from OPEC countries than was anticipated. And when you combine that with the third theme, that of China slowing and rebalancing its economy away from heavy industry and investment and towards consumption and services, which is much less commodity dependent, that gives another blow to commodities. Now you've got to remember China has got a pegged exchange rate, and that first theme of a stronger dollar that's come through with a stronger US economy has meant that China has appreciated its currency against pretty much every other country in the world,
Right.
just as its economy has been slowing. Now, what's happened over the last month is that China's stepped back and has started to use currency as a policy tool. It's given a signal of intent. Only 3% devaluation, but still a signal of intent. And that's made investors around the world worried that they could see deflation in profitability and in prices. That's really spooked a lot of people.
Is this the beginning of a bigger move in the markets?
Well, that is a $1 trillion question there. And after 10% down, you're always faced with the question as to whether it's a correction, a healthy correction, or whether it's the beginning of a bear market, which would be another 10, 20% down from here. We think this is a healthy correction that's come through that is reflective of the fact that there are enhanced risks in the global economy, and that's being rewarded now with enhanced valuations for new money from now on.
Is this a buyer's market then?
Certainly there are better opportunities now than there were before the price fall, and indeed we've been using the opportunity to buy those things that we've really quite liked that are now in our price targets, and we've also been using the opportunity to sell some things which actually rallied during this period of market turbulence that we don't really like so much anymore. In terms of is it the right time to just deploy money universally towards risk assets, that's not really coming out of the work that we've been doing on valuations. Things look fairish rather than absolutely compellingly cheap.
Do you expect to see change in investors' behavior?
Well, there was a lot of market turbulence in the early days of what was known as Black Monday.
Yeah.
You saw the US option market actually just shut for several hours. You saw large cap US stocks do 20% trading ranges during a day. And all of this, I think, has meant that investors will want to have some kind of dry powder with which to deploy if such opportunities recur from here. So probably people will want to keep a bit more dry powder, a bit more cash, run a bit more liquid portfolios. We have got better valuations which reflect that in some part.
So what are your preferred areas to invest in?
Well, we really like the Japanese equity market. We see that Japan was one of the casualties that fell a long way, while the earnings expectations that are out there in the market and that we have as a firm have actually been rising over recent years, and earnings have gone up terrifically well, and we expect them to continue to rally through. And so we've taken the opportunity to add further to Japanese equities. We also think that European equities look really good here. Our European equity team have just reaffirmed their strong expectations of earnings out of the Eurozone. They've reorientated their portfolios towards areas of domestic strength, away from some of the export to emerging market themes that were more useful in prior times. And we think there's some really compelling opportunities right now.
Well, thank you very much for your time, Toby, and thank you all for watching. We'll be back again next month.